Matthew, could you unmute yourself?
Yes, it's very good to see you, Nadia and Elena. Thank you very much for organizing this morning. And I'm here in San Francisco, so it's morning my time. I know it's in the afternoon yours. Can you see the screen?
Yes.
Very good. So today, Nadia and Elena have asked me to talk about options for investing in blockchain. And this is going to be a deep dive into all of the different investment approaches for investing in blockchain. So I think that this is probably a webinar that is more suited to those of you who are investors or are interested in this space from an investment point of view. As a result, I have to show you the legal disclaimers at the outset. I'm based in America, and we have strict rules about what we're allowed to talk about when we speak to investors. And so my family office, which is Fifth Era, and my fund of fund blockchain co-investors have to emphasize that we are not trying to solicit you today to invest in our company, and that if I make any statements about investment opportunities, you obviously have to make your own investment decisions and not rely solely on this webinar. Nadia asked me to introduce ourselves. On the left, this is my wife, Alison Davis. She is a Silicon Valley veteran of 30 years, as am I. We came here from England 30 years ago. And today, she is an early stage technology investor, and she's also a public company board director. And she sits on the boards of Fiserv and Calibra, and she just added Silicon Valley Bank, which in America is the leading technology bank. She's also chairman of the advisory board at Blockchain Capital and an advisor at Bitwise. I am Matthew Le Merle. I am also an early stage tech investor. I'm chairman of Securitize and vice chairman of SFOX, the crypto prime dealer. And with Alison, I also organize blockchain co-investors. In this webinar, we will talk about some investments that we are actually already investors in. And I will try and highlight that. They are examples. I'm not promoting them, but I want you to be aware that we are investors in some of these companies. We are also investors in 10 of the 16 blockchain unicorns through our fund of fund blockchain co-investors. And these are the 16 blockchain unicorns around the world. And you can see in the second column, highlighted in blue, the ones that we are investors in: Coinbase, Robinhood, Ripple, Kraken, and so on. Why should we care about blockchain and investing early in early stage technology companies, such as the companies that I know La Token introduces to investor groups? The reason is that whilst government bonds and the public equity markets have over 25 years shown returns of 3% in the case of fixed income, and 10 or 11% in the case of public equities. In the case of venture capital in America, we have much higher returns. The US Venture Capital Index over 25 years is a 24% net return, and early stage venture capital has an even higher return than that. In fact, early stage technology is one of the highest performing asset categories in the world. And the question, of course, is why? Why is early stage technology such a high returning asset category? The reason is that over the last 20 years, as everyone listening to this webinar is very familiar with, we have transformed the world economy. We have built out an internet that connects 6 or so billion of the 8 billion people that live around the world. And that internet has changed every industry and every country. And the internet that we've built has a high degree of connectivity, accessibility. It provides interactivity. So we're able to do this live streaming webinar globally right now, something we couldn't have done 10 or 15 years ago. And it provides a lot of flexibility and scalability. But the internet that we have isn't the internet that we need in the future, because the internet we have has some very fundamental challenges, issues. The first is it's insecure. It was intended to be a communication platform, and the protocols upon which it's built, such as TCP/IP, are communication protocols. They were not intended to be secure commerce, payment, and transaction protocols. So we are today confronted by more cybersecurity issues, hacking issues, phishing issues than ever before. And those are escalating as technology is being used to make those cybersecurity issues broader and deeper and more challenging for companies and governments and individuals. The second is that the internet has no notion of identity or trust embedded in it. We believe that we are communicating with the people that we hope to communicate with, but we don't know for sure. And sometimes the information that's coming from the other computer can be corrupted or used in other ways through, as I've mentioned, techniques such as phishing. The internet has become highly concentrated as well, and we'll talk more about that. But most important for today, the internet that we have has no native payments and it has no native assets embedded within it. And for us to get to a true digital economy over the next 20 years, we need to solve those challenges. We need a more secure internet, a digital economy. We need to have better systems of identity and trust. It needs to be more distributed, and we need native digital payments and native digital assets. This is the focus of the next 20 years, and the companies that solve these problems will become very valuable. Now, it turns out that when Satoshi Nakamoto wrote the Bitcoin white paper 10 years ago, he needed to, or she, or the group of people that wrote under the name Satoshi, needed to solve a fundamental problem. They needed to create a distributed, trusted, secure, native digital payment system, an electronic cash. And they called that Bitcoin. And in order to build that out, it turns out that they needed to solve exactly the problems I just shared. They needed a high degree of security built into the protocol. It needed a new form of identity and trust. By definition, it was going to be sovereignless and distributed. And it was a digital payment system, a cyber money, a crypto money, Bitcoin. But it also created a template for the creation of digital assets as well, which we now call tokenized securities. And we'll talk more about these as well on this webinar. So this is very important. This is why blockchain matters. Blockchain matters because it allows us to complement the digital economy that we're already relying upon and make it better. And if you speak to some of the pioneers here in Silicon Valley, they'll say the same thing. So for example, if you talk to Mark Andreessen, who was part of the Mosaic project and who built Netscape, one of the first browsers that helped us really use the internet in an effective way, Andreessen says that if he had understood the blockchain protocol when he wrote Netscape, he would have embedded it in Netscape. It's simply an important breakthrough in the world of computing and networking and the digital economy. So moving on, if that's why the blockchain protocol matters, then what are the investment themes? What are the investment themes that blockchain is being used for that we can benefit from as investors? And I've grouped this into three. Obviously, this is a technology stack upside down. But the first are foundational applications of blockchain technology, distributed ledger technology. And here we think that we will be using this technology to transform the way we compute, store, search, and secure content, data, and information. And in order to do that, we need to have underlying protocols and platforms and cryptocurrency systems that allow for the incentivization of network participants. And we also need new registries and identity systems and provenance. And right now, as we're living through this pandemic, it's become ever more important that provenance really matters. Provenance of people and of products and services and of information. The second level, because we are talking about a digital economy, is transactional. And here we're talking, I'm talking to a large extent about financial transactions, though of course transactions can take place between any two participants and they don't always have to be financial transactions. But in the world of financial transactions, we are going to have new monies, cryptocurrencies or sovereign-backed digital monies. And those monies need wallets and money services and payment systems and exchanges for us to use them. It doesn't matter if it's Bitcoin or if it's a Chinese digital yuan or a digital dollar or a digital euro. For us to use it in our digital economy, we need new infrastructure. And that infrastructure has to be built in the transactional layer. We do believe that there'll be more distributed finance, peer-to-peer marketplaces, peer-to-peer exchanges. And then all of this also has to be built at the institutional level. So large banks and payment companies, they also need institutional exchanges and custody solutions and settlement solutions. All of this has to be built. And then once we have the foundational level and the transactional level, then we can build out the application layer. And the application layer are where the enterprise companies build out infrastructure and services to use these new technologies. And here we're talking about supply chain and the Internet of Things and various applications on the enterprise side. And on the distributed consumer side, we think that we'll see applications that use blockchain to make content or gaming or social interactions more effective, and may indeed allow us to disengage from the advertising-backed world in which we live. And so, for example, we may have new browsers such as Brave, where we don't have advertising monetizing our clicks. Instead, we get to choose how our clicks are monetized, and we're the beneficiaries of that clickstream activity. So these are the foundational, these are the investment themes, the foundational, transaction, and application layers. And so for the rest of this, we will talk, the rest of this webinar, we'll now talk specifically about investment in this space. Now, here at LaToken, I did record a webinar a couple of weeks ago called Mastering Early Stage Investing, and it is a precursor to today's webinar. I'm not going to go through it today, but we talked about several important themes that are extremely important to understand if you're going to be an early stage tech investor. Here they are. They talk about the need to understand the exponential technologies. You need to invest early. You have a choice of whether you're going to be an angel or a VC, and if you're going to be a direct investor or an indirect investor. We'll talk more about that in a moment. And then it talks about sticking to the best practices, being very diversified, seeking out the best opportunities and the best investors, and being patient, because this is long-term investing. It's also high-risk investing. So I'm not going to reiterate any more of this other than to say you can find that webinar at the LaToken site. But I'm going to now focus on this framework, and the rest of this webinar will be talking about this framework. So this is now specifically about investing in distributed ledger technologies and blockchain and crypto. On this matrix on the bottom, we've divided the investment opportunities into those that are to do with distributed ledger technology. So these are companies using technology to build new products and services, as well as new companies on the left. And on the right, we have crypto monies, cryptocurrencies, and crypto assets that are being created with that technology. And on the other side, on the left-hand axis, we have traditional investment approaches, which are the approaches we always use. Stocks, indexes, ETFs, venture funds, funds of funds, and so on. And on the top side, we have emerging investment approaches, which are tokens and altcoins and the new funds, the crypto hedge funds, and so on, that are being created to invest in those new assets. We will talk about all of these cells, but we make this framework because there's a lot of confusion about all of the ways to invest in blockchain and crypto, and we're trying to simplify that through this chart. So I'm going to start in the bottom right-hand corner, and we're going to talk about cryptocurrencies and traditional ways to invest in those cryptocurrencies. Here, we would normally have indexes and ETFs. So if you wanted to invest traditionally into an asset, you would use a direct investment approach, and the majority of investments today in the public equity markets, as an example, are traded in indexes and ETFs. In blockchain, we do have some indices, some index companies. And on the left, I've indicated three. For full disclosure, we are investors in each of these three at Blockchain Co-Investors and at my family office, Fifth Era. But Pantera got out very fast, and they created a blockchain-based fund, an index fund. Grayscale, based in New York, which is part of Digital Currency Group in America, is probably our largest exchange-traded product. And they have both the GBTC, the Grayscale Bitcoin Trust, and they also have similar products for Ether and Zcash and other cryptocurrencies. And then Bitwise is a San Francisco-based crypto index company that has several different indices that allow you to invest in the top handful of crypto monies. All of these are vehicles that have some advantages over the direct ownership of crypto monies. The pros are that they all provide custody. They tend to provide a higher degree of security than if you have direct ownership of tokens. They allow you to trade and hold their vehicles in other accounts. And for many investors, we will have our money in accounts with financial institutions, and we'll need them to be able to hold our exposures in those accounts. And so in America, for example, ARA custodians, these are pension fund custodians like Pensco or Millennial, to use two examples, will allow you to hold Grayscale or Bitwise investments in the accounts that they're managing for you. Because these are big companies, they have a degree of liquidity that is good. It allows you to buy and sell more easily, and they have to be compliant. These are all regulated entities. The disadvantages are you pay a premium. You pay a premium to invest through a vehicle, and there are costs associated with these vehicles. And so in that sense, these are more expensive ways to invest than if you were to go direct in, and we'll talk about the direct investment strategy into cryptocurrencies in a moment. We're all waiting for the American SEC to approve ETFs. These are exchange traded funds. Right now, we don't have any approved ETFs, but when we do, it will allow the world's biggest institutions to offer cryptocurrency exposure to all of their customers. And so we're looking forward to the SEC approving some ETFs. Now, I'm now going to move to the top right-hand corner, and this is to use new investment approaches to gain the same exposures, the exposures to the cryptocurrencies. And so here there is more risk because these are new investment approaches, but some of them have less cost, and so they're more efficient approaches. The most obvious one is to just go and buy coins yourself. And here we're talking about cryptocurrencies. Later on, we'll talk about security tokens, but here we're talking about crypto monies. And so the easiest thing to do, and you could have done this over the last 10 years, is just buy some Bitcoin, or indeed any of the other leading crypto monies. The challenge here is it's not very easy. It's still not very easy, but back when this all began, you needed to be quite technologically sophisticated to figure out how to open wallets and accounts and use masking strategies to protect your identity and to buy these and self-custody them and make sure that you weren't phished or scammed or have your tokens stolen from you. So you can still be a direct investor in Bitcoin and other top tokens. The second is to use exchanges. And today we have a lot of very capable, compliant exchanges around the world. These are some of the leaders, and we are investors in each of these: blockchain.com, Coinbase, Gemini, Kraken. But of course, offshore, there are others. Depending upon where you live, there are some exchanges which are compliant for you as an investor. These are all compliant for an American investor. And offshore, there are others, a Binance or a BitMEX, which you have to be thoughtful about. Are you, as an investor in your jurisdiction, allowed to use those exchanges? That depends upon where you live. The advantages of these exchanges is that they are large, they provide liquidity, they do have expenses and costs associated with them. And then we've also seen the emergence of the prime dealers. And these three are the three leading crypto prime dealers: Amber in Asia, and then here in America, we have SFOX and Tagomi. Again, we're investors in all three of these, but I'm vice chairman of SFOX. The advantages of the prime dealers is that they actually combine the order books of the exchanges. And so the more sophisticated you become as an investor and trader in crypto monies, so the more you will care about these five things: liquidity, speed of transaction and trading, the safety of the platform and of your account, the price and cost of the trade, including the spreads that you're paying, and the compliance, especially if you're in a jurisdiction where investors have to be compliant. The crypto prime dealers provide combined order books. They combine the order books of all of the exchanges. They provide liquidity, and they provide trading algorithms, and they have extremely secure platforms. So whereas an exchange may go down for an hour or two or a day, perhaps, the prime dealers can't go down because they simply route around one exchange if an exchange is down, and they find another exchange to affect your trade. So you have a higher degree of likelihood of security and not being impacted by outages. And then the prime dealers should be able to provide the lowest sources of Bitcoin. They have the lowest fees and the narrowest spreads. And the good ones are only trading on regulated exchanges. So this is that second choice: buy the tokens either directly through exchanges or through the crypto prime dealers. And all of these are available to all investors. In America, we have to be accredited. In other parts of the world, different rules may apply. Now, in this top right-hand corner, we also have crypto hedge funds. And these are typically new firms and new funds that are creating vehicles that allow you to get exposure to crypto monies and crypto assets. But we've put them in this corner because they are emerging investment approaches: new firms, new funds, and sometimes new investment strategies. And of course, the underlying cryptocurrencies are new assets or new monies. We maintain a database of about 500 at Blockchain Co-Investors. We use the database to figure out which are the blockchain venture funds that we want to invest in. But I wanted to share some of the data, and this is also drawing upon PwC. But for us, we estimate that there's about 250 or so active crypto hedge funds, excluding the indices and the blockchain venture funds that I've already talked briefly about. Of these, most of them are small. 60% have less than $10 million under management, and the average fund's only $20 million. So in the world of funds, these are very small funds. There are a few exceptions. There's about 15 crypto hedge funds that have more than $50 million under management. And most of the funds that we have in our database are based in the US. Now, I should say that we don't have as much Asian data as we would like. So this is simply how our database is constituted. there's a breadth of strategies being used. So just like in hedge funds, people have used different strategies, discretionary, quant, fundamental, and so on. We're seeing all of those strategies being used in the world of crypto monies as well. The fees are typically quite high, 1.7% annual management fee and 23.5% performance fee on average is actually quite high in the world of hedge funds. And that also, however, reflects the fact most of these funds are very small. And most of them, and this is very important, most of these funds are managed by investment professionals who are new to investing. So across the crypto hedge fund world, these crypto hedge funds are available, but they are small, they are new, and they are high risk. And you have to be very thoughtful about choosing them. And there are also some very important issues with the underlying assets that are being traded. And if you're going to rely upon algorithmic trading strategies that a crypto hedge fund may be using, you have to ask, is the underlying data deep? Is it reliable? Is it consistent? Is it going to continue to be true? And we have some questions here, which I won't go through all of in the interest of time. But you have to do your own due diligence, and you have to be sure that you believe that the trading is real, not fake, that the price discovery is occurring in an efficient way, and that the algorithmic trading strategies of the crypto hedge fund you're going to invest in are dependable. So these are all issues that you would worry about before you invest in a crypto hedge fund. So now I've covered off the right-hand side. I'm now going to go to the bottom left-hand corner. And here we're talking about traditional investing in startups that are using distributed ledger technology. And in this bottom left-hand corner, we have three strategies. You can be a direct investor, you can be a limited partner, an investor in a blockchain venture capital firm, or you can be an investor in a venture fund of funds focused on blockchain. The goal of direct equity investing, of course, would be to have exposure to the leading unicorns in the space, the most valuable companies. And we've already talked about this framework here. I flipped it upside down. So we have foundational, transactional, and application-focused companies. And I've also shown North America, Asia, and the rest of the world. And these are the 16 blockchain unicorns we talked about before. At the foundational level, a lot of them are mining companies, Bitmain, Canaan, eBank, Bitfury. Some of them are protocol companies like Definity and Block One, and Ripple is an interesting hybrid company as well. At the transactional level, most of them are exchanges and wallets. And then we have very few application companies that are today worth $1 billion or more from an equity perspective. And these are the ones we're investors in. I already mentioned we're investors in 10 of the 16. So you can be a direct equity investor, but to be a direct equity investor, you need to have the capability to invest in early stage technology. You need to have good deal flow. You have to be capable of doing your due diligence. And you need to meet the best practices of early stage investing that we shared on the other LAToken webinar called Mastering Early Stage Investing. And this is very important if you want to be a direct equity investor. Well, the next option is to be an investor in venture capital funds focused on blockchain. And we have some data here about those funds. We think there's less than 100 of them in the world today that are long-term traditional venture investors focused on blockchain. Most of them, again, are small. Only 10 of those firms manage more than, manage half of the capital and have assets more than 50 million. 2/3 of them are first-time funds. And that's not necessarily a bad thing. In the world of venture, first-time funds can be very high-performing funds. They tend to be small. They tend to work very hard. And for us, at least in our database, 2/3 of them are in North America. Once again, we probably have a little less Asian data than we would like. So these are some high-level facts about the venture capital community focused on blockchain. These are some of the top funds. And what I'm showing here, again, is by North America, Asia, and the rest of the world, some of the leading pure play blockchain VCs. Now, at the bottom, Draper, RRE Ventures, Sequoia, and Union Square Ventures are general purpose funds that are doing a lot of blockchain investing. The challenge is if you want to be an investor in those funds, you have to be able to have, well, you need a lot of capital. Their investment minimums may be in the tens of millions of dollars, and they tend to be oversubscribed. And of course, if you do invest in them, they're general purpose funds, which means only a very small percentage of your money would go into blockchain. You'd have exposure to other types of technologies like life sciences, clean technologies, of course, enterprise technology, and so on. So above the line are the pure play blockchain VCs. And in North America, you can see some of the names: One Confirmation, the Andreessen Crypto Fund, Blockchain Capital, where Alison chairs the advisory board, and so on. We are investors in all of the ones that we put in pale blue, because as I've mentioned to you already, we operate a blockchain venture fund of fund. In Asia, these are three of the leading long-term venture capital firms: Dragonfly, Hashkey, and Kinetic. And we're about to be investors in two of these three. And in the rest of the world, in Europe and elsewhere, there are some very good firms. In London, we're investors in 1KX and Fabric. In Switzerland, there's Bluefolio, Libertas, as well as a fine firm. And there are others. These are not all of them. But for you as an investor, you can approach these firms directly. You can find them online. Some of them will have minimums as low as $100,000, which I know is a lot, but if you can afford that, they will allow you to be limited partners in their funds. The better firms are raising their minimums, and sometimes they'll have a $500,000 or $1 million minimum. So this is obviously requires you to have a lot more resources, perhaps be a family office, but it's an investment strategy that is definitely possible. And then the last choice, which I can't talk about a lot on this conference, is to find a fund of funds. And that's our strategy. We are a fund of funds for blockchain venture. I can't talk about the specific of our fund of funds because this is an open webinar, and we're only allowed to have qualified client investors. So I can't speak about the specifics, but this is our personal strategy. And you can learn more about it at blockchaincoinvestors.com. There are benefits to fund of funds, and the biggest one is diversification, though there are additional costs associated with fund of fund vehicles. So now I've talked about all three of the cells, except for this one. And this last cell is actually very important because it's the future. New emerging investment approaches that allow us to gain exposure in a digital asset format to traditional investment opportunities, including the equity of blockchain startups. This is the world of tokens, and this is obviously a world that LaToken is more active in. So I'm going to talk a little bit about this, but I do emphasize, I think this is more about the future. And we're seeing a lot of infrastructure being built to support digital assets, including security tokens. So digital assets, I say they're the future. It turns out 30 years ago, we began to apply technology to asset classes. We did that first with public equities. And today, the public equities of the world are all digitally traded. And so we've already applied technology to public equities. But it turns out we didn't get there yet with most asset classes in the world. And so if you take private equity, if you take fixed income, many forms of fixed income, bonds and loans and so on, if you think about funds of all sorts and real estate, property, almost all of those asset classes are still paper-based. Which is remarkable. Even though we have rolled out the internet and we have digitized and technology enabled a lot of the world's industries, most of our investing is still paper-based. And that will change. In the coming years, increasingly, we will apply digital technologies such as we've been talking about, blockchain-based and distributed ledger technologies potentially, to asset classes. We've started doing that. And so in America, we've taken real estate such as the St. Regis Hotel and put that onto a blockchain-based security token. We began to tokenize funds. Blockchain Capital created the first tokenized venture vehicle, BCAP, and there have been others like Spice and Cosmo and more. And we've begun to also create security tokens around other forms of funds, and some of the world's largest asset managers, the Fidelities and the BlackRocks and Vanguards and Invescos of the world, are now also beginning to look at this technology, as are the world's largest exchanges in London and Zurich and Tokyo, New York, and so on. So digital tokens are coming, and I know that it's already possible to find digitized private equities, and these can be in security token form. They can also be traded on exchanges. In America, where we're covered by SEC regulations, we have to worry a great deal about the compliance of the tokens, as well as the compliance of the exchanges on which those tokens trade. But some of the people watching this webinar are in other jurisdictions, and then you obviously have to be aware of the rules as they apply to you as an investor. And it's possible you have more investment opportunities than we have in America. I'm chairman of Securitize in Europe. Securitize is America's leading STO company, and we are tokenizing securities and making them available for other people to buy and sell and trade. And I think that most of the US compliant security tokens have been issued by Securitize. And then I have here a couple of examples of people that you can talk to if you want to know more about this. Obviously, LaToken is involved in tokenized assets, typically of private investments. And I also highlighted a Swiss firm that is creating the world's first fund of security tokens. It's a fund of fund for security tokens called Tavis Digital. And I think that's a very creative approach. These are just examples, but this is the fourth and final way to gain blockchain and crypto exposure. And I think increasingly this will be a more substantial portion of the world's investments. Everything that I've been talking about is talked about in the book that Alice and I wrote, Blockchain Competitive Advantage. You can find it everywhere, Amazon, Apple, Smashwords, paperback, hardback, ebook, Audible. And it will tell you more about why we believe digital assets and digital monies are the future. And then if you want to learn more about blockchain co-investors, just come to our website and sign up. And then we also have a free ebook, which I believe Elena and Nadia are going to be sharing, but you can find that at fifthera.com/ebook. And it talks about the logic of what I've described. These are my personal contact details. We're always interested in talking to investors. In particular, we're very interested in talking to fintech, internet, and blockchain investors. And so these are my personal contact details. If you're an entrepreneur, we also recorded with LaToken a webinar called Raising Early Stage Capital. And if you're an entrepreneur, I would encourage you to watch that webinar, and it will talk about some of the resources that are available to you. So I've finished the organized conversation that I wanted to, Nadia. I know I've taken a lot of time, so I'm not sure if we have time for Q&A. But Nadia, if you do, if we have time for Q&A, I'm happy to do it, or else you can just move us straight forward, whatever is your preference.
Okay, thank you so much, Matthew. Your webinars are very popular all the time. So, thank you so much for this in-depth presentation. We will share it to our audiences and during the broadcast 24/7 on our VCTV. What are your current impressions of the segment? And what else would you like to comment on the current situation with blockchain?
Yes. Well, I think it's a good question, Nadia, and I know that we've got some great speakers coming up in just a moment. Andrew Bull, who's going to talk about some of the legal issues, and Lu Zhang, who's going to talk about some of the big data insights he's getting. and I'm looking forward to those conversations. For me, I think I should talk a little bit about the pandemic. And the thing that I think is most important, obviously it's a terrible thing, and it's a challenge for us and for many businesses around the world. But as early stage tech investors, what's fascinating is all the adoption curves of all of the technologies that we are building upon has just gone up very steeply. And so if you think about the use of electronic commerce and digital payments and digital wallets and virtual health and virtual education and virtual entertainment and communication, all of these things are being used right now more than they've ever been used. And whilst many of us were early adopters and we were already using them, most of the world was not. And so the laggards, all of those people that didn't want to use electronic commerce, they didn't want to use digital payments, they're all learning to use them right now. And so that's increased the adoption curves of all of the underlying technologies that the startups that you and we are backing are building upon. And we actually think that's very exciting for the digital economy and for the companies that are building within it. Now, I don't want to get overexcited. Obviously, this pandemic is a terrible thing. But as investors, there's definitely a silver lining here, especially for early stage tech investors.
Thank you so much for your detailed comment on that, Matthew. Thank you for this brief conversation, and introduce our second keynote panelist for today, Andrew Ball, with a keynote on cryptocurrency regulation and fundraising as understanding the regulatory landscape as applied to digital assets. So Andrew Ball, founding partner of Ball Blockchain Law. So Andrew, could you please introduce yourself briefly and share your screen for the presentation?
Absolutely, no problem. Thanks for having me, appreciate it. Let me just share my screen real quick. All right, can everyone see the presentation?
Yes, yes.
Okay, great. All right, well, thanks for having me. Really appreciate it. So as indicated, my name's Andrew Bull. I run a law firm based in the United States called Bull Blockchain Law. And our entire premise is based around the blockchain and cryptocurrency industries. So I'm going to give a kind of a talk about the regulatory background, as well as some considerations that companies who are either existing in the space or entering into the space should consider in regards to not only tokenization, but also just the general application of distributed ledger technologies. Before I do that, just to give you a little bit of background about myself. So I came across Bitcoin back in 2011, and I got pretty involved in it when I was in law school and wrote my thesis about the regulation of cryptocurrencies. That was back in 2013. And around that same time, I started building GPU miners and ran a mining company and a digital asset fund till about 2015, 2016. From then on, as the legal industry, and I'm going to highlight a lot of the regulators who got involved, as they started getting more and more involved in providing clarity and guidance, the industry itself started kind of expanding into the traditional legal space. And we kind of saw this amalgamation of traditional law being applied to this very advanced technology. And a byproduct of that is now we have pretty much an entire subset of the law that is solely dedicated towards digital assets, distributed ledger technologies, and kind of how they exist in a multitude of different industries. So from after running a mining company and the digital asset fund, I kind of decided to pursue the legal side of things full time. And since then, we worked on quite a number of projects. I know that Matthew had highlighted securitizing a lot of security tokens and digital asset projects that have been launched on that platform. We've been representation for a lot of those projects as well. And then also we represent everyone from gaming on the blockchain to digital payment systems that are maybe offering cryptocurrency purchase options, exchanges, et cetera, et cetera. So just a quick brief overview of what I'm going to talk about. It's very much focused in on the legal side, and because I'm based in the United States, there will be that lens, but I'm also going to touch on other jurisdictions because, as we all know, this technology is quite expansive and really doesn't take into consideration a lot of times the boundaries that we've all implemented in our jurisdictions. And so throughout the presentation, I'm going to highlight a lot of considerations that companies should consider, and as well as how they would apply in specific jurisdictions. So just to kind of give a brief overview, I think one of the largest hurdles a lot of the times in any jurisdiction from a regulatory standpoint is simply the regulators trying to understand how this technology operates. Now, we've seen that, especially in the United States, in regards to tokenization and the ICO boom of 2017. And we saw a lot of regulators who kind of turned their focus toward the industry because there was this consumer protection concern. And 9 times out of 10, a lot of the administrative rulings that we've seen from governmental agencies, both in the US and abroad, have been very much focused around this notion of trying to protect the consumer or the participant or the individual who is potentially purchasing a token or using the platform. And that really kind of helps give some insight into the statutory language that has been interpreted in terms of these regulators finding something that a company potentially did wrong, or maybe they didn't do enough compliance or register or obtain a certain license, especially in regards to the digital asset payment context, as well as the offering context. And so when I get into the offering context in a little bit, I'm going to highlight a couple of the different provisions as well as exemptions that companies can use in order to ensure that they don't end up like some of the companies that I'm going to highlight in a second. So in the beginning, the Financial Crimes Enforcement Network here in the United States was very much focused on combating fraud. And there was a large concern over the usage of traditional cryptocurrency in terms of fraudulent use. And so the beginnings, we really saw clarity and guidance that was put out by the governmental agency that focused on ensuring that they were protecting individual investors and individual participants. From there, we started seeing a much more of the traditional finance industry and fin technology industry. Those players and stakeholders started getting involved. And as a result, the regulatory lens expanded out beyond the consumer protection focus and really started getting into trying to address what happens when businesses are actually launching their own technology platform and providing some element of service, or maybe they're developing some token that's tied to that platform. And of course, we'll get into this idea of the different types of tokens that exist and how the regulation plays into that. So in the United States, we kind of have a little bit of inconsistency across governmental agencies in the way that they address the definition of currency as well as a potential cryptocurrency definition. And for a long time, there was this debate over whether Bitcoin was a commodity or a currency. And that was between 2013 and 2015. And we had a long industry debate over which one it was going to fall under from a compliance perspective. Interestingly enough, in certain circumstances, it is considered a commodity. We can see that the CFTC, which really handles futures trading and margin lending and things like that, they are very much focused on the notion and have categorized it as a commodity in certain contexts. And then also we've seen the seminal Dow report being the major administrative ruling that the Securities Exchange Commission did here in the States, which had a really significant impact on the industry. This was late 2017 and really was a direct reaction to the ICO boom that we saw on a global scale. And what they were trying to do was really trying to figure out, okay, is a token an actual security? because if it is, then we have significant compliance regulation, not only here in the States, but also in a lot of the major jurisdictions, including the EU, Asia, that have to be taken into account from a business standpoint in order for those individuals and businesses to really make sure that they're compliant and they're not running afoul of this statutory language. So the DAO report, for those of you who don't know, it was a decentralized autonomous organization, and they launched a token that was very much focused around this notion from a participation perspective. Individuals could acquire the token, and then they could also participate in this decision-making process via the DAO. And the SEC ultimately used a very traditional securities test, which comes from an old Supreme Court case called the Howey test, which I'm sure the majority of us have heard at some point or another if you're operating in the industry. And they took this traditional test and applied it to this cryptographic token that was offered in this offering. And they ultimately decided that it was a security. And the reality of it is that they've kind of taken this perspective that certain tokens can be securities and expanded upon it in a couple different administrative rulings. However, we don't necessarily have on a national scale any clear legislative guidance or any real set in hard, fast rules that need to be abided by in regards to whether a token is a security. Now, of course, we have subsequent guidance rulings from the SEC, and they have provided clarity as well as initial guidance that they've provided as well to stakeholders in the space. But the reality is that they've taken these administrative rulings, they've decided that this is the outcome of each individual case. And as far as setting precedent, it helps for guidance in the industry, but there's no hard and fast rules that have come out of that. And I think that's really important to understand, not only from an industry perspective, but also from a governmental perspective, is that in the United States, we are viewed as kind of having a pretty hard take on the industry. However, at the same time, we do have to acknowledge that these administrative rulings are all very isolated opinions and don't necessarily mean that in any given future situation, if you mirror your token to the DAO token or some other token, that the same outcome is going to occur. And in the United States, we say that the administrative branch is the fourth branch of government, because through their administrative rulings, they are, in a sense, creating regulation. And so, and in this, my law firm, we did a study in partnership with the European Union over the securities laws here in the States, as well as those in the EU. And we also highlighted some in jurisdictions in Asia. And really the overall consensus is that while we have these traditional rules that are very much real and applied, and anyone operating in the space would do themselves a disservice if they weren't going to take them into consideration, there are still significant limitations in the way that these are applied to determining whether a cryptographic token is in fact a security. And also just touching on, there's a lot of kind of misconception about this utility versus security perspective. And this, a couple of administrative rulings, one of which is the Munchie token. This really highlights how even if your token has some functionality on your platform, that doesn't mean that it's not going to be a security. And the SEC has been very clear about that, especially in the last couple of years in their administrative rulings, is that even though individuals or groups or businesses have developed some token that provides functionality or maybe provides access to the platform, that doesn't necessarily result in the token not being a security. And going back to the Howey test in terms of determining whether that token really put an idea in the purchaser that they were going to make money off of it in the future, and how that token was going to increase in value if it was tied, in fact, to the efforts of the company who created it, then they are still going to potentially be a security token, even if this token is really providing utility. Now, in Munchie, I want to highlight one specific aspect of that ruling as well, is that the company itself, the actual actors of the company, they went to investors and they told investors that not only was the token going to increase in value, but it was also going to be listed on secondary exchanges where they were going to be able to trade it. Now, before I get into the advent of the security token industry and the outgrowth of these administrative rulings, I want to highlight that for those of you who are out there, if you are considering a token and you're in a jurisdiction where it's ambiguous whether the token is potentially a security, even in the United States, for example, the one consideration and one thing you really don't want to do is you don't want to tell potential token purchasers that that token is going to be a higher value than what it is when they purchase it, because that will almost always guarantee that if the SEC takes a look at your platform and your offering, that you're going to have resulted in issuing a security. And so if you haven't done the proper compliance, the proper filings with the SEC, you could potentially be on the hook for violating the Securities Act of 1933, which is where the SEC derives their statutory authority. Now, going back to the Munchie situation, the secondary exchange, I think, is also a consideration in that the Munchie representatives talked to potential token purchasers about how they were going to facilitate the listing of the token on the exchange. And in the industry today, a lot of companies now are doing initial exchange offerings where they're partnering with exchanges. And I want to be very clear about one thing, that if you go out into a jurisdiction that has at least moderate securities laws and you issue a token via an exchange through a partnership with that exchange, and that exchange is of course taking on the compliance role, that is not going to completely absolve you from your obligations to make sure that you're doing the proper filings with whatever the security regulator administrative agency is in that jurisdiction. And just to kind of give you a little bit of more insight in that regard, you want to make sure that if there are previous decisions, especially, for example, you take the United States, where we have this Munchie decision, we have the Dow report and subsequent administrative rulings, where if you are taking the chance, the regulatory risk of not making these filings, then the best thing you can do is really avoid discussing this type of expectation of profits, which is the third prong of the Howey test. Because at the end of the day, the SEC, they're going to look at the perspective of the investor, not the perspective of the business. So if the investor themselves, regardless of what the business has done, thinks that they are going to make profits based off of acquiring this token or this digital asset, that is going to be a very large, significant contributing factor to the governmental agency determining that the token is in fact a security. So overall, I think that your considerations in regards to whether you're going to make the compliance effort for determining whether your token is a security is going to be very jurisdictionally dependent. So the United States, I always recommend to clients that they consider that making sure that they're filing, or they also make sure that they break down their token and really evaluate its purpose and existence, because the SEC actually has proposed a recent safe harbor rule, and kind of championed by Hester Pierce, who is one of the commissioners at the SEC, that allows for a company to have a kind of a 2-year grace period where they can go about building up their system and actually generating a token, so long as they can provide evidence to the SEC in that 2-year period of time that they have a sufficiently decentralized platform. And of course, that is an open-ended discussion and really open-ended kind of term, in that no one fully knows what a fully decentralized platform is from the regulator's viewpoint, meaning that even if the business itself has this idea and they think that it's fully decentralized, that doesn't necessarily guarantee that when the SEC evaluates it from the Howey test lens, that they're not going to still have the outcome that the token is a security. But at least we have some steps towards recognition of the notion that there's uncertainty, and therefore this safe harbor rule is hopefully going to become more prominent and industry actors are going to use it. So just relating back to the recent slide that I am on, and talking about the regulation of tokens, it's really important to make sure that we're acknowledging that there are futures considerations in regards to the way that tokens are not only transferred but traded, and how there obviously has been this large debate in the space whether certain organizations should have regulatory approval to offer actual options trading or futures on cryptographic tokens. And so when thinking about the US Commodity Exchange Act, we really kind of evaluate whether certain exchanges who haven't necessarily complied with the CFTC, whether what they're doing is in violation of the act. And so really the largest consideration there, and my firm represents a couple different exchanges, and as well as we've also represent clients who have sued exchanges on behalf of individuals as well as businesses for potentially violating the Commodity Exchange Act, because those that are out there that are providing margin lending or with borrowers and lenders and things like that, if they're not filing the proper registration requirements through the Commodity Exchange Act, you as a business owner or somebody who operates in the space should be very careful in terms of not only dealing with them, but also obviously using their services. And that's a really large factor in terms of not only the compliance requirements for the business itself, the actual exchange, but also the compliance requirements for the business that is going to potentially be using that platform. So when you think about, say, an investment fund who is going to avail themselves of a platform that allows for margin lending, there needs to be a pretty significant vetting process as well as consideration. And so we represent a couple different hedge funds as well as traditional funds that are very much focused in on this general notion that they want to be very careful that not only do they have potential recourse against the exchange service or third-party services that they're using, but also that that third party has done the proper filing requirements. And that actually bleeds back into this general notion, especially with the advent of initial exchange offerings, that companies should be very careful to make sure that they go out and do their own compliance, regardless of the fact that they've potentially entered into a contract that the exchange has said, yes, we'll take on the bulk of your tokens and list it to our customer base, handle all the compliance side of things. But what if it turns out that your token is in fact a security and that exchange is not a registered exchange with the governmental agency in that jurisdiction? There's potential issues there, and there could be potential long-lasting impacts to not only your business as well as the exchange's business. So those are kind of some just high-level considerations when you're operating in the industry to make sure that you're taking into consideration not only the third-party service platforms that you're using, but also what type of compliance that those third-party service platforms are actually implementing. So talking about the same context, really, this retail commodity transaction is that from a legal perspective, I always kind of make sure that clients understand that if a platform is offering their services to the wider public, and it has to do with the exchange of tokens, as well as potential trading, processing, things like that, that they want to be very careful. And as of just recently, we saw a pretty significant class action suit filed against a lot of different exchanges for violations of the Securities Act, as well as the Commodities Exchange Act, based on the notion that they were launching IEOs, they were launching their own tokens. We've all seen these exchanges now that have been very profitable, that have launched their own token that is tied to the profitability of their platform. And 9 times out of 10, I mean, that in of itself, if there's a profitability element of that token, it's, especially in the United States, is most likely going to fall under the compliance requirements and potentially be a security. So even individual investors should be wary of those opportunities as well. While those individual investors might not necessarily be doing anything wrong, their investment could potentially be in jeopardy based on the notion that this exchange is potentially violating those securities laws. And also that is really important to acknowledge that we want to scale that back and think about it from a jurisdictional context, because if we have an exchange like Binance that is hopping from jurisdiction to jurisdiction based on the regulatory benefits that they find in those jurisdictions, then we want to make sure that we're also factoring in the notion that they need to be doing the compliance in the exchange that the user is actually in as well. So long as they're doing that, then it's sufficient. But as an individual investor or a business investor, you want to make sure that you're doing that due diligence to ensure that the funds you're investing are not going to potentially be lost because of subsequent lawsuits that have been filed against the exchanges. And so the recent class action suit that listed a lot of big parties in the space, they're really going after this notion that they did in fact violate the Securities Exchange Act as well as the Securities Act by creating their own token and issuing it to potential investors. So I want to kind of get a little bit more specific now in regards to businesses that are operating in the space, especially in regards to the payment processing side of this industry. So we saw a pretty expansive technological endeavor kind of pursued by a lot of different companies in this industry, where they're setting up payment system applications that allow for individuals as well as businesses to be able to potentially conduct transactions as well as transfer funds and so on and so forth, that would potentially fall under what in the US we call money service businesses. And this is a multi-jurisdictional consideration as well, because not only do you have to consider your compliance requirements from the payment processing perspective, but you also have to consider your compliance requirements in relation to the users that are actually coming onto your platform. So a really good example is, say I, as a business, create an app that allows people to buy and sell cryptocurrency. Let's just say they can only buy and sell Bitcoin, so that we remove the securities question for a minute, because we know that in the States and the majority of jurisdictions, they've kind of unequivocally said, not necessarily through legislation, but we've had presentations from regulators and discussions with them that have said that they will not be treating Bitcoin as a security. So we'll move that question off to the side. Regardless of that, even if a company is in the business of conducting transactions and processing payments, they need to make sure that they're considering the separate actual compliance requirements for businesses that are operating in fintech and processing payments and money service businesses. And so the United States is a little bit unique in that we have federal requirements from a compliance standpoint, where you have to file with the FinCEN as a money service business. But then depending on the operations of the business, and a lot of exchanges have had to do this, is that you may need to get what's called a money transmitter license in the individual states that you're operating in. Now, if we expand that and go over to Europe, it's a little bit of a different take, and we have a different perspective, because they don't have this federal and then state regulatory basis that is the underpinning for money transmitter licensing, but instead have more expansive regulations that encompass a larger amount of countries, rather than in the States where we have a specific state-by-state compliance requirement. And so in considering the breadth of the payment processing services that your company is offering, I would definitely suggest that you take into consideration what jurisdictional lines those payments are actually going across, as well as what are your compliance requirements in terms of processing those payments. So just to take the United States as an example, and I really think that the Financial Crimes Enforcement Network has been at the forefront of providing a lot of guidance that has been used in the States as well as abroad. When I've traveled over to Asia a couple of different times on security token press tours, things like that. And one of the things that comes up a lot is determining whether businesses themselves that might not necessarily be offering a token or offering exchange services, where do they fit into the hierarchy of their compliance requirements? And so the reason I bring up this slide is because in the United States, we have an exchange, an administrator, and a user. And as you can see, there are differentiating factors that contribute to whether those individuals or businesses are falling under that category. And so what is really important for businesses that are operating and maybe offering that application that I was discussing before in regards to allowing users to purchase or buy and sell or transfer Bitcoin, that they need to make sure to determine what category they fall under. And so while they might not necessarily be an exchange in that maybe their services are limited to simply the transfer of Bitcoin, in that I can go on their application and simply just transfer Bitcoin to somebody else, but I can't buy and sell. Then they are not going to necessarily be an exchange and not have this additional money transmitter licensing requirement, but they may be an administrator because they're engaging in this processing of payments, and therefore they need to make sure that their compliance filings meet that definition criteria that we find in the statutory language of in the Bank Secrecy Act in the States. And of course, a user does not necessarily have these compliance requirements, but at the same time, as a user, you want to make sure that you're doing your due diligence and evaluating the platforms that you're using, as I was highlighting before. And so you want to make sure that if you are using that type of platform that is conducting those types of transactions, that they at least have done some compliance in regards to the jurisdiction that they're in. So we have an administrative ruling as well here from Ripple, where it was back in 2014, which lends support to this general notion that you can basically have a scenario where a major company issues a token and then allows for the processing of payments on their software platform, and then potentially violated some statutory language. And so the majority of us, obviously, considering the previous presentations, know about Ripple Labs, which is the software development company of Ripple. And they were actually fined by FinCEN back in 2015 for their operations as a payment processing based platform. And there's a lot of nuance and nitty gritty in regards to that opinion that I'm not going to necessarily get into. However, the general gist and takeaway was that just because you create a software platform, that doesn't necessarily absolve you from the compliance requirements that are subsequently triggered when people take that software or build upon that software. And so a really good example of this is the Ether Delta platform, which was an exchange based here in the United States that was considered one of the first decentralized exchanges. And the individual who had created it, Zachary Coburn, he really ultimately was caught on the hook of violating the Securities Exchange Act, because even though the platform was based around this decentralized notion of just simply software, he went above and beyond and actually advertised the platform and also kept a book of orders on a separate server. And so it wasn't fully decentralized, which ultimately led to the regulatory oversight and regulatory ruling that occurred in that context. So similarly, in terms of the advent and creation of distributed ledger technology, software developers should also be cognizant of their responsibilities when they're developing a platform that they may open source to everyone and have access to anyone on the platform. That doesn't necessarily fully absolve those individuals or businesses that have developed that software. Because if somebody takes that and subsequently, say, uses Ether Delta to conduct security token transactions when Ether Delta isn't qualified and or filed as a security token exchange, then they're going to basically have the same amount of culpability from a regulatory perspective. So I'm going to skip the state regulation, but I'm going to talk about now in the security token industry, the most popular examples, especially in the United States, that have basically come across in terms of allowing the compliance to occur as well as the token to be offered. And the most prominent exemption is Regulation D. And so that is really kind of one of the biggest things in regards to the exemptions that really kind of come at the forefront. And so I know that I have 5 minutes left, and I'm really just going to highlight really just the important aspects of this. Security token offering platforms. So not only the security token exchanges, but the actual businesses that are generating a token, a digital asset that represents some underlying economic right. They need, if they're offering their token in the United States to potential investors, need to most likely seek an exemption to the Securities Act. The most prominent one is Regulation D, specifically 506C, which allows these investors to basically participate in purchasing the token from this business because this business has filed as an exempt offering under the Securities Exchange Act of 1933. And what this allows them to do is to go out, solicit accredited investors, and be able to allow those investors to participate in the actual raise itself. There are limitations in regards to resale, and also we're seeing kind of now an expansion of the security token exchanges, which have been in develop now for multiple years, but we're seeing some of them now have launched and are operational. And so we're seeing that aspect of the industry, but these security tokens aren't going to go be listed on the main token trading platform on Coinbase or something like that. It's not going to be on Bittrex, right? Like, these digital securities are in themselves securities, and therefore retail investors, especially from an introductory investment perspective, are not necessarily going to have that ability to participate in that. However, of course, you take into consideration Rule 504 as well as regulation crowdfunding, which allow for the ability of these companies to go out and raise funds through a security token, but also allow them to potentially sell them to retail investors who aren't accredited. And you can take that and also expand that to different jurisdictions and really think about, okay, if I'm a US-based company, or even if I say I'm a Cayman-based company and I'm offering my token in the US and as well as another jurisdiction, I need to make sure that I'm equally compliant in both of those jurisdictions. And so while your exempt offering in one jurisdiction may be sufficient, it might not necessarily mean that you're exempt in that other jurisdiction. And so when we've done international raises, we've had to go in to each one of these jurisdictions and really determine what are the best compliance practices, as well as potentially whether there are filings for these types of companies. So Regulation D 506C, which is the one that I touched on, and also I just want to highlight that the SEC is now providing some clarity and have submitted a couple different proposals to increase the amount of money that those who are doing Reg 504 or Reg CF would be able to raise. Now, Reg 504 right now is capped at 5 million, and Reg CF is capped just above 1 million in any 12-month period. But the SEC has shown an interest in expanding those numbers to higher numbers so that companies who are operating in the space could potentially take on that initial capital and be able to not only avail themselves to accredited or qualified investors, but as well as individuals that could participate that are retail investors. So that is the majority of my time. Again, my name's Andrew Bull, and I run a law firm called Bull Blockchain Law. And we are based in the United States. We have clients in many different jurisdictions that are really trying to understand the compliance side of this business industry, as well as making sure that they're not running afoul of any statutory regulations in the jurisdictions that they're operating in. So thank you very much, and I'll put it back to Elena.
Thank you very much, Andrew. And I have a brief question to you as well. What would you say about the current crisis and the impact of COVID-19 on your industry and the blockchain projects, which with the regulations you outline?
For sure. Yeah, no, it's a great question. And it's been a large consideration recently. And I think the biggest impact has really been on how investors or potential business owners who are launching their token can actually target investors in this new age. Now, I touched on the general solicitation of accredited investors, but one of the large considerations, and I kind of talked about this previously, is companies need to be careful on how they're addressing investors through the digital age, right? So for example, if they're going to go out and offer their token to somebody, they need to potentially establish a pre-existing relationship with that investor. And there are limitations in regards to who they can kind of just mass communicate to. So I think the largest impact right now, especially from a digital security token perspective, is the way that these companies go about ensuring that they're not soliciting to everybody and potentially violating statutory provisions that have been in place for quite a long time.
Thank you. And what demand do you feel mostly for which formats of blockchain projects or maybe funds in this scope?
For sure, yeah. So there's a significant amount of demand for not only just digital asset funds, as well as digital security token offerings. And like I said before, we've worked with Securitize for a long time on a lot of their projects, and a lot of companies out there who aren't necessarily involved in the industry or even understand the industry are getting involved and really seeing the benefits of tokenization and the ability of transferability between investors as well as the general public in regards to the security token and what those economic rights are. So, for example, we've issued equity tokens that where a token represents actual ownership in the company, or maybe it's a real estate platform portfolio that has a dividend that's distributed to token holders based on the profitability of the real estate. Those are examples where we've seen a lot of demand recently, and I think it's because of all the regulatory instances and examples that I was kind of discussing before. They all are coming together on a multi-jurisdictional scale and allowing traditional companies as well as those operating in the industry to really have a more clear path in regards to how they're going about offering those economic rights via a token. So we've definitely seen a significant amount of demand there. And then also we've seen a significant amount of demand in the payment processing context. So exchanges applying for BIT licenses in New York, or they're getting their money transmitter licenses in specific states. We have payment application apps that are offering their services now in multiple jurisdictions, and they're ensuring that they're doing all the compliance there. So that's where a lot of the demand is as well.
So investors could feel secure in terms of advancements in the legal scope, in terms of both blockchain and the new instruments available on the market. So what would be your suggestion in terms of risk return adjustments for investors and maybe jurisdictions to use, apart from those questions which you covered already in your presentation?
For sure, yeah. From a jurisdictional standpoint, and again, I wanted to highlight that the US has a pretty significant, stringent regulatory regime, meaning that we are kind of at the top, close with a couple other jurisdictions that are very much not necessarily anti the industry, but it's just the regulatory requirements are pretty significant. There are plenty other jurisdictions out there, especially when you have smaller GDPs and there's an incentive for that jurisdiction to have the ability to go out and allow companies to come in, or maybe they focus in on actual legislation. I know that we have Bermuda and Liechtenstein are kind of at the top of that list, as well as Malta. And we kind of have these examples where these jurisdictions allow for this very specific focus of the regulators in terms of the legislation that has been passed. And like, for example, in the States or other jurisdictions, some in the EU as well, where we don't necessarily have that clarity. And so I think that's a consideration. One of the issues, and it's kind of a double-edged sword, is that in the jurisdictions where you have the most strict regulation, a lot of times that's where the most significant opportunity is, especially regarding potential investor pools and the marketing and networking that it can be done in those jurisdictions. And so I think that's kind of a large consideration for a lot of businesses, is that they can do their entity formation and do their licensing requirements in the jurisdictions that are favorable. But if they want to enter in or offer their token or their services in these larger jurisdictions, they're most likely going to still need to be compliant with those rules as well.
Thank you so much for that in-depth replies and for your presentation. I'm sure that our audiences, which are primarily serial entrepreneurs of different series and stages of fundraising, and investors will appreciate that. And we'll have it broadcasted out 24/7 VCTV widget. Thank you so much, Andrew. And I will introduce our next speaker with the keynote, Zhang. And Zhang is Chief Data Scientist, and he will address the issue what real-time manufacturing data is showing about COVID-19, and we'll also speak about the impact of today's situation on the sector of manufacturing. Hello, Lou.
Hello, thank you for the introduction, Elena. I'm going to share my screen and get the presentation all set up here. So as Elena said, I am the Chief Data Scientist at Machine Metrics. We're actually going to change gears a little bit here. I'm not going to be talking directly about blockchain or Bitcoin. I'm actually going to be talking about another interesting topic for all of us, which is colloquially known as alternative data. Alternative data is basically sources of data that are new and atypical. So if you think about how data has been traditionally disseminated and collected, it's traditionally been through surveys, through polling people. Think about the census, and this has really been how information has been collected over the past couple of centuries. However, with the advent of new technologies like IoT and sensors and edge computing, we are now able to usher in a new age where data is not collected from people, but it's collected directly from the source. And so that's really what I'll be talking about today. And the company that I'm with is Machine Metrics. We are a VC-funded industrial IoT company. Our goal is to democratize manufacturing and make it as transparent and visible as possible. So this, for everyone who's not familiar with manufacturing, this is what a typical manufacturing facility that manufactures discrete components looks like. So you have these machine tools and these operators all at their individual stations. This is not ideal because each individual operator only knows what's going on their machine, and the factory manager essentially can only get information by talking to each one of these people. These machines are not interconnected, and the data coming off of these machines typically is not being aggregated or analyzed either. So a common problem is when at the end of a day, someone might realize that they're 10% behind on the number of parts that they have to make, but really they don't find out until it's too late and the customer comes knocking at the door and they don't have the parts that they need to deliver. So this is a big problem. So where do we come in? We try and make this process of connectivity as easy as possible. We have two hardware devices. The first is called an edge device, and the second is called an I/O device. What we do is we plug directly into the programmable logic control, that's what you see here, of the machine tool, and we extract the data directly from the machine with our proprietary technology that basically cleans, senses, and analyzes this data. These are basically C++ adapters that can read directly off the control of the machine tool. And this is a large part of where our intellectual property is. So what does the customer get from this? So the customer gets these nice dashboards, basically. And in these dashboards, you can see things like how your machine is operating, whether it's on or off, how many parts it's made, if it's up to spec, if you're at the goal, all sorts of great things. But what happens when you aggregate over many, many, many different machines? So we've been doing this for about 5 years. And at this point where we have hundreds of customers, we're North America centric, thousands of machines connected, 5+ years of manufacturing data warehoused. We actually just passed our billionth part that we track, and we track over $1 billion of capital equipment as well. So when you get to this sort of scale that we've gotten to at this point, you can get some really interesting industry trends out of this. So what we've been sharing every day on LinkedIn during this coronavirus crisis is a 7-day moving average of utilization on machines. So a machine is being utilized when it's on and machining parts, and it's not being utilized when it's off. So very simple concept here. So we can look at the last 3 years of data, 2018, 2019, and 2020. What might immediately stand out to you is there are some very distinct events that happen that you can see in our data. For example, Easter every single year impacts our data at different times because Easter occurs at different times every year. You can also see things like Thanksgiving and Christmas and other US holidays. What we find also interesting is that at the beginning of every year, there seems to be a bump. And all of these lines, interestingly enough, are parallel to each other, which means that at the beginning of every year, you kind of see an acceleration of manufacturing happening at sort of the same pace. And that's really people coming out of the holidays and getting that first beginning of the year bump to fulfilling their manufacturing quotas. So here I kind of want to paint a narrative with our data. Basically, if we zoom in to each one of these separate periods in 2020, we'll first look at mid-January to mid-March. So what's going on here? Really, what's happening is this is what we know as the good times. You know, the U.S. and China signed the Phase 1 trade deal on January 15th, and we got a stronger than usual post-holiday bump that we saw in the machines that we track. On February 7th, the US was so confident about their ability to deal with coronavirus that we actually sent 18 tons of PPE to China. Our customers internally reported that they had increased orders due to Chinese factory shutdowns. So you actually see sort of this strong continued growth going on throughout the early months of this year. On February 15th, the WHO sounds the alarm. The World Health Org basically says that they're concerned about the lack of urgency in funding the response from the international community. This actually directly coincides when we see an 8-month high in US domestic utilization of machines at 29%. Of course, this can't last forever. On March 11th, a global pandemic is declared, and US domestic utilization immediately reverses direction. So now we get into the bad times, mid-March to mid-April. What's going on here? On March 16th, the cases outside of China start to outnumber the cases inside of China. Our customer shutdowns really start to be in force. You see this deceleration of utilization that is really quite evident in these beginning days of March. On March 19th, the New York Times reports a severe shortage of PPE, and our customer shutdowns continue to intensify and accelerate. On April 1st, the height of the health crisis, really, there's a weekly doubling of global cases. So every week, basically, you're experiencing a 2x increase in the number of cases. What we see in our customer base is that we have customers start to retool and help make ventilators, which helps flatten the curve a little bit. But by April 15th, 40 US states have stay-at-home orders, and coincident with the Easter holiday, the US domestic utilization actually hits a low point of 21%. This is the lowest point of the entire pandemic and about a 33% decrease from the highs that we saw just a couple of weeks ago. So what comes next? Is it the flattening? Unfortunately, not so much. What we see is on April 27th or April 22nd, the WHO declares a stabilization of Western European cases. Our customers start reopening their factories and retooling, and this really starts to outnumber the number of shutdowns, which is evident by this increased curve that you see here. April 28th, however, we start seeing supply chain disruptions. Rockwell Automation, which is a major US manufacturer, announces that they delay their reopening because of supply chain issues. We also see this internally with our customer base. Customers really start operating at a lower utilization rate. And you know, unfortunately, because of supply chain issues, the sustained increase is not necessarily able to be carried out through the rest of April. On May 1st, the World Economic Forum actually recognizes this as a problem. They report on severe supply chain disruptions. Basically, what's going on here is the raw materials, the inputs like the bar stocks and the metals that are being used to manufacture are not able to be delivered. And in addition to that, the end markets where our customers sell to are also getting garbled. And unfortunately, they're not able to deliver their product, or the demand has certainly just collapsed on that end. And so our next step is really to dig into each individual industry. What's going on with each individual industry? For this, we reach out to the American Manufacturing Association. Basically, they are the lobbying group that represents advanced manufacturing, and they help us categorize our customer base based off of these common industry verticals. So American manufacturing typically has about 30% representation in automotive. So we're a little underweighted in automotive. And I think there's about 5 to 10% in medical devices. So we're a bit overweighted in medical devices. So just keep this in mind as we move forward. Contract manufacturers, for those of you who don't know, are basically people who will be able to manufacture for multiple different industries based off of current demand. So they can retool and they can basically reconfigure their shops to whoever is paying them to manufacture parts. So we can overanalyze this all we want, but basically what we see here are two important trends. The collapse of automotive, there's about a 40% decrease in automotive utilization from the beginning to the end of March. And there's actually a relative stability of medical manufacturing. So that only collapses by about 4%. And this is because, if you think about it, ventilators, medical equipment, that's still going to be needed regardless of whether there's demand in the economy, because this sort of stuff is the equipment that will actually help get us out of this pandemic. These customers of ours are manufacturing necessary life support equipment, and that's not going away anytime soon. So medical manufacturing historically was in third place and has really moved up to first place as of late. And so we get a lot of questions from people about how people can actually use this. So the first use case that we see is that our data is able to anchor conversations in reality. We talked to a VP of sales who said that his regional managers basically said that their sales forecasts were going to be down 50%. Our data only shows that overall the utilization collapsed by about 17%. So that really helps get a more rigorous approach to these sorts of methods. We also spoke to some VCs who said that when they buy machine shops, oftentimes these machine shop owners claim an average of about 60% utilization. But if you think about that, that's absurdly high. Nobody's using their shop 18 out of 24 hours every day. Our data shows 30%. So oftentimes when they come to these people with our data, it can kind of temper those conversations. The Federal Reserve of the United States also releases a metric called capacity utilization, G17. And we often get a question as to why we run at about half of that. The reason is because the Fed collects their data through surveys. So basically they survey all of these major manufacturers every month, tens of thousands of companies, and these companies self-report how much they think they're utilizing their shops. So if anyone knows anything about survey methodology, self-reported surveys are rife with bias. People sometimes just don't know, sometimes people will over-report due to pride, but because we get to the source of the data, the actual machine tool, and we're attached to the programmable logic control, we don't have any human touch our data ever. Basically, it's cleaned automatically and it flows into our database and into these graphs. And we get these insights autonomously. Really what we see here is the truth, and it's not swayed by any human bias. So use case number 2 is, this is really an alternative source of data for economic benchmarking. The New York Times reported recently that the economic data that we usually get, like PMI and industrial production, these sorts of things, it's about to get weird. And the reason it's about to get weird is because these are, again, self-reported numbers from factories. And when you're in a global pandemic, your first priority is not to report to a government organization how many sales that you've made. So we really are seeing, at least in the United States, a collapse of people reporting reliable numbers to these traditional government institutions. And so that's where we can step in. Our data isn't collected via surveys. We don't care if you answer a survey or not. We're going to get your information regardless because we're attached to your machine. And so Forbes actually did an article on us in early March when US manufacturing was quite strong, and coronavirus had not really been recognized in the US at all. And they said that COVID-19 may actually be delivering a local manufacturing renaissance. We did show that in our data, but unfortunately, as you all know, that's not true. Basically, you can't escape science. basically eventually this pandemic reached our shores, and it affected us greatly. It collapsed manufacturing, but in the early stages of this pandemic, we were indeed seeing a uptick in utilization. And then finally, we're able to assess the surprise impact of COVID-19. Nobody knew that there was going to be a global pandemic this year. And what we allow people to do is we allow people to get the day-to-day data of manufacturing to respond in an agile way. And so whenever you're in situations where there's a lot of uncertainty and there's a lot of change, you can't wait for monthly benchmarks to come out. You have to know from a day-to-day basis, even a minute-to-minute basis, which is what we can supply, where the truth is. And that's really what we've seen people use our data for. They can use it to anchor conversations in reality. They can use it for policy decisions. Business owners can use it to basically have a more rigorous take on what's going on in the industry as a whole. So that's it for me. I wanted to keep it short and keep it open for questions. I know that a lot of the information I presented here is rather novel. This is a pretty novel concept. Again, we're a VC-funded company, so we are taking the long run approach to this. Basically, as you know about VC-funded companies, we're able to take big bets and risks in order to capture the market. And that's our exact intention. So, during this time, during the last couple of years, we've been hooking up thousands and thousands of machines across North America. We've been able to get these insights. And, this is really a byproduct of our main business. Our main business is to provide machine monitoring and insights to factory owners. But as a side effect of this, we have really become an authority in providing, unbiased third-party information on manufacturing trends and economic trends. So with that, I will hand it back to Elena, and feel free to ask any questions you have of me.
Thank you so much, Lou.
Thank you.
Thank you so much, Lou, for the presentation. And you mentioned as well that you also advise your clients on trends and maybe new niches in the COVID-19, or maybe what new niches in your segment we'll see in terms of being attractive for investments, maybe in your sector. And what would you advise to our investors to maybe attract their attention to startups and in these fields?
Sure, I think that's a great question. So I'll speak to manufacturing as an industry because that's where my expertise lies. I would say, like, as you guys have all evidenced here, we are really in this new era where we can get data that was previously not able to be aggregated before. So if you think about businesses like Facebook or LinkedIn or Google, how they make money is by aggregating your data. The reason their product is free is not because they provide you no value. It's because they are essentially data aggregation businesses, and they can aggregate their data just like we aggregate ours and give all sorts of trends. They can refine their search engine methods. They can create network graphs. They can get all sorts of insights. So the area of investment that I really see going forward is companies like this, companies that have VC backing. VC backing is actually quite critical in this day and age because unfortunately, you're not going to be able to capture the market without it. So having that long, 10, 20-year runway to do this and be able to find a niche where you can aggregate data and get insights that nobody else can will really help you build a moat around whatever company you're trying to build. And I think the name of the game here is building a data moat. So whenever you can build a sort of barrier of entry against new participants with strong data, with aggregated data like we have, you really make yourself invaluable to the industry. And that's where I think a lot of startups are going these days.
And what do you think about privacy and data? So there are lots of disputes on that, because probably some of experts consider that in the new age or new normal is that we mostly have no privacy, because major data aggregation tools and companies, they're now a bit out of the scope of this privacy. What do you think on that?
Yeah, so that's a good question, and I think that's actually where blockchain comes in a lot. I think blockchain is great for privacy, but I think even bigger than that, as this question gets to, privacy is a major concern in the 21st century. Basically, all our stuff is up on the cloud. Send a message on your iPhone through iMessage, that's going up to Apple's cloud. When you send an email through Google, that's going up through Google's cloud, and that is being stored and analyzed. So there's no getting away from it, first of all. This is here to stay for us. This is the new normal, and it's not going away. So then the question is, how do we ensure that we are the best possible stewards of data? So we leverage basically AWS, Amazon Web Services, for that. We don't manage our own privacy and security. We let one of the biggest companies in the world manage it for us, Amazon. The DoD, the American Department of Defense, also does that as well. Basically, they have started moving towards Amazon's cloud, and it's just a fact of life. These big corporations, they will essentially be they will supply the infrastructure for security for the rest of us, for better or for worse. And they have all sorts of security mechanisms in play. They're $1 trillion company. They have masses of engineers working on this to make sure that security is of utmost importance. But I think that's the best we can do at this point. Really, is to kind of accept that model is the way it's going to be, and try and ensure that we all do the best job that we can to make sure that we do our own due diligence and make sure that we're putting our data in places and with people that we trust.
Yes, and that was my next question about this big data engineering and facilitation. Is there room for newcomers in the field to manage that, or we can only work, as you mentioned, probably with the big giants, big corporations who can manage and offer this level of security which is needed?
Yeah, so that's a good question. The common model right now is actually for these giants like Amazon or Google to buy out small startups like us, frankly. So this sort of innovation happens much quicker at the startup level. Usually what you see is big companies are not necessarily agile enough to be able to make these sorts of plays that we are. They don't have the niche experience that we do, but the real business model behind a lot of VC companies right now is to identify a certain niche, really be able to master it with your own domain expertise and with these proprietary tools that you develop, and then get purchased by a larger company. So I think there is room for new entrants, but you really have to question, what is your niche? What are you good at that these big companies can't do with their size and their lack of dexterity? And then target that and really see if there's a business opportunity there.
Thank you. And my final question is for those businesses who are already taking this challenge of pivot their business models during the crisis. Is there any solutions for them they can use to quickly move to this kind of digital world, remote work, and so on, what we have now?
Yeah, so I think that's really a two-part answer. So first of all, it's important to note that this a pandemic is temporary. So if you look at pandemics throughout history, like 1918, the 1918 Spanish flu and things like that, they don't last forever. Eventually you develop herd immunity, or there's a vaccine. So this is temporary. This is not a systemic thing that has plagued our world. This is just something that we will get past. So for those people who are asking that question, I would answer and I would counsel that during this period, your goal should be just to get through it as best as you can. Don't necessarily focus on trying to do all that much extra, or trying to exceed and do more than you can. Just focus on getting through it the best that you can. Frankly, this will hopefully be over in another couple months. But the best we can do, at Machine Metrics, we're just heads down, chugging through day by day, doing the best we can, and we'll see what happens with our best effort. So approaching it with a sense of equanimity and being able to kind of just work through it at the best of your ability, I think is the advice that I would have on that part. And then for the second part, I would really say that if you're in this sort of business, this big data business that we're in, it's actually not necessarily a bad thing that this pandemic is going on right now. Of course, it's bad for public health and it's bad for the economy, but this has actually catalyzed a lot of movement that would not have happened for many, many months, if not years. So one example of that is during this pandemic, we have actually started to not just read data off of machines, but we've started to control machines. So this is incredibly useful, as you may think, because when you can't have people come into your factories because of state shutdowns or ordered shutdowns, and you still want to get production done, and you can have a company like us, who's already connected to your PLC, be able to issue commands to it and move it around, that is incredibly powerful. So certain industries and certain businesses who have that sort of capability to, this is basically like the automated factory, where we're pushing faster into the automated future, where for better or for worse, lesser and lesser humans are needed. This is catalyzing that process, and it's making it come much quicker than it would have otherwise. So to those who are looking to seize on an opportunity in this day and age, that's where the opportunity really is.
Thank you so much, Lou. And I thank all the keynote speakers for today. And of course, we're welcoming you tomorrow for our Startups Leaders Club and roadshows. Please join us for different formats of our investor startup leaders communication, and stay healthy and find new ways out of the current situation and new niches, new investment opportunities, with all the best wishes for the day. Thank you.
Thank you.